Something strange is happening in Canada's housing market right now. Rents are falling, home prices are stuck, and one hidden policy shift might quietly be keeping the whole system afloat. After reviewing the latest data and expert analysis, it's clear to me that Canada's housing market is in the midst of a pretty significant transition. And this isn't just some temporary shift, it's the start of a deeper structural transition that could impact home prices in Canada for decades to come. So in this video, I'll break down the three biggest forces driving this change, and more importantly, what they mean for Canadians looking to buy, rent, or invest in real estate in the months and years to come. So over the past year, the Canadian housing market has transformed in ways that most experts weren't predicting. And we're seeing some unusual trends, like rent prices decoupling from purchase prices, breaking all the usual rules of real estate. And despite a full year of interest rate cuts, home prices are pretty much stagnant across most of Canada. And so there's a lot to unpack here. So let's dive into what all this means for you, your family, your finances, and your future housing decisions. Starting with one of the biggest factors influencing the Canadian housing market right now, immigration. And when we look at immigration, we need to look at it in two distinct categories, because these categories impact housing in completely different ways. Those two categories are permanent residents, or people who will stay in Canada for the long term, and then non-permanent residents, who are often international students and foreign workers. So, after years of growth, Canada's non-permanent resident population actually declined for the first time since late 2021. Specifically, our non-permanent resident population dropped from 3.05 million in October 2024 down to just over 3.02 million in January 2025. That's a decrease of about 28,000 people. And while that might not sound massive, when you consider that in previous quarters we were adding 150,000, then 120,000, and then an additional 50,000 people, it's a pretty sharp reversal. And it marks the largest quarterly drop since the early days of the pandemic. So this could certainly be an early sign of a larger decline in temporary immigration in Canada. But on the other hand, the story with permanent residents is a bit different. In 2024, Canada welcomed 484,000 new permanent residents, which was just below its target of 485,000. And initially, the government planned to maintain a target of around 500,000 new permanent residents per year through 2025 and 2026. But as these targets have come under more scrutiny, they've dialed those targets back to 395,000 new permanent residents a year, which is a significant reduction. But what makes this really interesting is that these two categories of immigrants affect housing completely differently, because permanent residents who are planning to stay in Canada long term are much more likely to buy homes rather than rent, since they're looking for stability and want to put down roots. But non-permanent residents who might only be in the country for a few years are typically looking to rent. So looking ahead, we're looking at a slight decrease in the population who are looking to buy homes and a more significant decrease in the population who are looking to rent. But of course, immigration is just one piece of this puzzle, and we also need to look at what's happening with interest rates. Because after a full year of rate cuts, the Bank of Canada recently surprised a lot of people by deciding to hold rates at 2.75%. And this pause came despite some economists calling for continued cuts, while they're concerned about trade uncertainty and economic headwinds. And the Deputy Governor of the Bank of Canada, Carolyn Rogers, talked about housing head on, saying that they've seen a pretty big drop in housing activity, particularly in the Toronto area. And she pointed to a combination of factors for why that is, which mostly comes down to an increased supply of purpose-built rentals and condominiums, plus the effects of those changing immigration policies. But she also said housing has had a sort of outsized impact on our economy for a while. I think it's been overtaken more recently by trade policies. And as Rogers alluded to, that's a pretty important shift when you consider how crucial housing has been to Canadian economic policy for years. And this brings me to a really critical difference between this current cutting cycle and the dramatic rate cuts that we saw during the pandemic. Because back in 2020, when the Bank of Canada slashed rates to near zero, the housing market took off overnight. But this time around, despite an entire year of rate cuts, the housing market remains relatively stagnant. In fact, national home sales have declined, with a 9.3% drop in March 2025 compared to March 2024. And the average home price also decreased by 3.7% year over year, settling at $678,000. But back in 2020, the Bank of Canada didn't just lower rates, it also started buying a lot of government bonds. And this move, which is known as quantitative easing, pumped a massive amount of money into the banking system, so banks suddenly had more cash than they knew what to do with. And even though Canada doesn't require banks to hold a certain amount of cash, because reserve requirements were removed in 1992, this extra money made it easier and more appealing for banks to lend. And as a result, loans became more accessible and the housing market boomed. But fast forward to today, even though interest rates have been cut again, the Bank of Canada is doing the opposite of quantitative quantitative easing. Instead, it's letting those bonds it bought earlier mature without replacing them, which is known as quantitative tightening. This means that there's less extra money floating around in the banking system, and with less cash on hand, banks are more cautious about lending. So even with lower interest rates, the housing market isn't seeing the same surge that it did back in 2020. Now, this difference in liquidity becomes even more important when we look at what's happening in construction, because it's in the construction market where we see some of the most dramatic shifts. On one side, purpose-built rental construction has completely taken off, and that's largely thanks to new policies introduced in December 2024, like expanded low-interest loans from the government through CMHC, bigger tax breaks, and even direct grants to developers focused on rental housing. And as a result, we've seen the number of rental units under construction shoot up, and nationally, the supply of purpose-built rentals jumped by over 4%, pushing vacancy rates from 1.5% to 2.2%. But when you look at homes being built for purchase, it's a completely different story. Across the country, housing starts dropped 9% year over year as of April 2024, and in places like Ontario and BC, that drop is even higher. And the reality is, high construction costs, expensive land, and tighter financing conditions are making it a lot harder for developers to build homes that people can afford to buy. So what we're left with is this strange imbalance. More rental units being built, but fewer new homes hitting the market for buyers. And then pair that with the drop in non-permanent residents, who are usually the ones renting, and you get more supply but less demand in the rental market, which helps explain why rents have slowly started to come down in a lot of Canadian cities. But at the same time, permanent resident immigration numbers haven't actually dropped yet, and the lack of new housing options for buyers means resale prices, while not quite at their 2022 peaks, have basically just stayed flat. But of course, there's more shaping the housing market right now than just immigration trends and construction numbers, because the sales to new listings ratio gives us a sense of whether we're in a seller's market where demand is high and prices usually rise, or a buyer's market where supply outweighs demand and prices tend to fall. Typically, anything above 60% is considered a seller's market, below 40% is considered a buyer's market, and anything in between is viewed as fairly balanced. And so right now, Canada as a whole sits in that balanced zone, with the national sales to new listings ratio at 45.9%, which helps explain why home prices have stayed relatively flat over the past year. Not soaring, but not crashing either. But if you zoom in on specific cities, then the story starts to shift. The latest data from RBC shows that Toronto has recently dipped into buyer's market territory with a sales to new listings ratio of around 27%, meaning more homes are being listed than they are sold. Montreal, on the other hand, is still seeing strong demand with a ratio of 64%, putting it in seller's market territory. And then other cities like Calgary and Edmonton are sitting in the middle, in line with the national average. So while interest rates and demand are certainly part of the story, it's this mix of policy decisions and local market conditions that's really keeping Canada's housing market in this unusual state of calm. And when we look at the condo market in the big cities, it tells an even deeper story, because prices for a lot of units have dropped pretty significantly, especially for pre-construction condos. The problem is that many of these condos are now worth much less than what buyers agreed to pay for them just a few years ago. And so normally, when a buyer goes to get a mortgage, the bank checks how much the condo is worth right now. But in a lot of cases, that number is coming in way lower than the price the buyer agreed to earlier. That means that the buyer would need to come up with a lot more cash to cover that gap, or they could lose their deposit and face legal trouble. So to avoid this, some banks and developers are using something called a blanket appraisal. So instead of checking the value of each condo one by one, they just say all the units are worth the same as the original price. This helps buyers still get their mortgage and close the deal, even if the condo is technically worth less now. So in that sense, it's kind of like a quiet bailout, because it helps people from walking away and crashing the market. But while it helps in the short term, this could be really risky in the long term, because if too many people owe more to the bank than their condos are actually worth, that's a ticking time bomb if prices continue to drop even further. But zooming out to the bigger picture, it's clear that the Canadian housing market continues to live in a state of flux. So following these kinds of trends won't tell you exactly what's going to happen, but it will help you make smarter choices based on your own situation. And in a time like this, being clear on what's right for you is a valuable place to be. So if there's one thing this housing market is making clear, it's that you can't always control where prices go or how policies shift. But what you can control is how smart and how prepared you are with the money you spend every day. And one of the easiest ways to build wealth, no matter where you are on your journey to renting or buying a home, is by making sure the dollars you spend every day are working for you, not against you. So to learn how to get the absolute most out of what you're already spending, watch this video next.